welcome to this deep dive. Our mission today is, well, it feels pretty urgent. We're going deep inside Bitcoin.
Right.
We want to understand its current state, this consolidation, and figure out where it's truly heading.
Exactly. And to do that, we're dissecting some very specific internal research from Mo and the Maestrodamos research team.
So this isn't guesswork.
No, not at all. This is about historical data, market structure, and trying to find some real clarity, especially with all the noise around the four-year cycle and, these liquidity narratives that are everywhere.
And you might be feeling confused right now. I mean, it's completely understandable.
Oh, for sure.
You look at the broader market, gold's hitting all-time highs, the S&P is just pushing up and up, and yet Bitcoin has just stalled. It feels stuck.
It's a frustrating grind, and it's a huge disconnect, especially when you remember that the internal models were pointing to a potential cycle peak. What was it? Around $126,000 in October 2025.
And ever since that moment, it seems like the loudest critics are all shouting the same thing.
That the cycle's broken.
Yeah, that this rhythm that's defined the asset is finally fundamentally broken.
But our deep dive into this research, it's going to show you why the data suggests the exact opposite.
So this isn't a breakdown.
No, it's a necessary, if, very frustrating structural phase. The most crucial insight we found is this. The fundamental four-year cycle is absolutely intact. The clockwork is still ticking.
But something has changed.
What's shifted dramatically is the character of the peak. Who was involved? Yeah. And that changes everything about the downturn that follows.
Okay, let's unpack the timing first, because that seems to be the foundation here. The data confirms the cycle duration.
Yeah.
It holds true.
It does. From the prior bottom to that projected October 2025 high, this cycle lasted 1,062 days.
Which is almost identical to previous cycles.
Almost identical. The rhythm is mathematically consistent. The beat is still there.
Okay, so if the rhythm is consistent, why does this downturn feel so dramatically different? It's nothing like what followed 2014 or 2018.
It's all about behavior. I mean, think back to the 2017 and 2021 peaks. What do you remember?
Mass retail hysteria.
Exactly. Parabolic moves, extreme social risk. Everyone from your barber to your neighbor was suddenly a crypto genius.
Right, classic euphoria tops.
And euphoria tops lead to catastrophic crashes because all those late-stage retail buyers, they're highly leveraged and they spook easily.
So panic sets in, and you get a 60–70% crash almost overnight.
That's
final liquidation.
Wipes everything out. But that didn't happen this time.
No, social interest was, it was there, but it was muted at the highs. It wasn't a frenzy.
Precisely. And the research identifies this as the first, get this, the first apathy-driven Bitcoin cycle peak.
Apathy-driven.
Yeah. The top was led mainly by large institutions, by sophisticated players. It topped out quietly without all that retail mania that gets the media's attention.
And that institutional leadership just completely changes the market dynamics.
Completely.
So if you're looking back at the past, expecting that immediate violent crash, that's why you're confused now.
That's it.
In 2014 and 2018, by this exact stage in the cycle, Bitcoin had already crashed 60–70%. Real capitulation.
This time. The drop is only down, roughly 30–40% from the high?
And no massive leverage blowups, no mass panic.
None of it. Instead, we have this slow, frustrating grind, this long horizontal price action. It's not designed to scare you out.
It's designed to bore you out.
That is the signature of an apathy-led top. It tests your conviction slowly.
That makes perfect sense. Frustrate the weak hands instead of panicking them. Okay, let's pivot, because the second huge discovery in this research, it really changes how you have to view this asset.
This is the big one.
We need to talk about the liquidity thesis, this idea that Bitcoin is just a follower of the central bank money printer, specifically M2 money supply.
And this is where we have to, overturn some common wisdom. The research shows that narrative failed, and it failed spectacularly.
Also,
we have to reverse the cause and effect. Bitcoin. It's a leading indicator of liquidity. It does not follow it.
Okay, that sounds pretty radical. For years, we've all been told that M2, the broad measure of money in the economy, drives risk assets like Bitcoin.
I know, but the timing data is undeniable. The research shows that historically, Bitcoin tops 6 to 8 months before M2 peaks.
6 to 8 months before.
In every single observed cycle. It's incredibly consistent.
So if you were on the sidelines waiting for the Fed to ease or for M2 numbers to roll over,
You were already months too late to sell the top. That lag is critical. It changes Bitcoin's function entirely.
it's not just riding the wave.
No, it's ringing the alarm bell. It's signaling that a structural peak in liquidity is coming before the traditional financial system even registers it. It's a super sensitive early warning system for monetary stress.
Why, though? What's the mechanism that makes it so far ahead of the curve?
It comes down to market structure. I mean, Bitcoin is non-sovereign, it's global, it's highly liquid, and it trades 247 with almost zero friction.
Yeah.
So institutional capital, that smart money, it can move in and out of a high-risk hedge like Bitcoin much, much faster than traditional indicators like M2 can ever reflect.
So they're pricing in future policy shifts.
They're pricing it in first, way before that policy shift actually happens and filters down into the broad money supply data.
Okay, so if the liquidity narrative is backwards and Bitcoin is leading, then what is the direct force keeping it suppressed right now? What's driving this apathy-driven consolidation?
It's the macro conditions, specifically the things controlled by the central banks, and the key driver is fear of systemic risk.
What's the signal for that?
We see a really tight correlation in the data. Every single time unemployment has ticked up, even a little, Bitcoin has stalled or faced pressure.
So you're connecting unemployment directly to Fed policy. Walk me through that.
Sure. The Fed doesn't care about the price of Bitcoin. What they care about is systemic risk, stability in the bond markets, and, equities.
The stock market.
Right. So when unemployment rises, it signals that the economy is weakening. And that weakness increases the chance that the stock market will eventually feel enough pain to force the Fed's hand.
To force them to pivot to easing.
Exactly. And until that systemic pressure builds, monetary policy stays relatively tight, which is just inherently bearish for high beta, risky assets like Bitcoin. The tight policy just ensures this slow grind continues.
This combination, the external pressure from the Fed, the quiet institutional top, it's starting to sound a lot like a specific period in the past.
It does.
The 2019 parallel.
It's remarkably similar in its market structure. I mean, look back at 2019, Bitcoin topped quietly, and then you had quantitative tightening, or QT.
The Fed shrinking its balance sheet.
Right, pulling money out of the system. And that QT period led the market into a long, grinding bleed that just tested everyone's resolve.
Yeah, the research points out that QT ended again in late 2025. That timing feels pretty important if 2019 is the roadmap.
It is. The structural pattern is what matters. Quiet top, followed by a tight monetary environment, followed by a long consolidation.
We're seeing that exact structure repeat itself right now.
We are. The market has priced in the fear, it's priced in the apathy, and now it just waits for the Fed to blink because of some other economic distress.
So if history is rhyming this closely, let's look ahead to 2026. What should you, the listener, be anticipating?
The models are pointing pretty directly to a counter-trend rally in early 2026.
A fake out.
A classic fake out. It'll be a lower high, but it'll be significant enough to convince a lot of people that the bear market is finally over.
So they'll buy in aggressively.
They will, and then the market will likely roll over into deeper lows later in the year.
That's the cruel card of these cycles, isn't it? The false hope. What about altcoins? For people interested in those high beta assets.
Altcoins are the riskiest play here. A real broad alt season. It needs two things that are just completely missing right now.
Okay, what are they?
One, you need massive public attention and hype, that euphoria we talked about. And two, you need loose monetary policy to flood capital into all the speculative corners of the market.
And we have neither. We have apathy and tightening.
Precisely. So the conditions just aren't there. This means high beta assets, like Solana, they're likely to really underperform what people expect based on the last bull run.
What about something like Ethereum?
The research notes that larger cap assets like Ethereum might hold up a bit better, probably because of greater institutional adoption and its utility narrative. But a broad alt season, that widespread rotation into high-risk alts, it just can't happen in this environment.
Okay, so let's talk timing. When does this structural pain finally end? When does the bottom actually form?
Well, historically, the bear market lows form very reliably between October and December, following the cycle peak.
So given the 2025 peak, that points directly to October 2026 as the most probable month for the absolute cycle bottom.
That's the baseline, yeah.
But you mentioned macro could speed things up.
Absolutely. An earlier low, maybe around April or May of 2026, is definitely possible.
And what would cause that?
That would happen if some unforeseen economic data forces a faster, more decisive policy shift from the Fed, like a sudden, sharp rise in unemployment or some other systemic event.
And if we do see that earlier lows in the spring, should we feel confident? Is that the bottom?
History suggests you should be cautious. Even with an early low, the research indicates there would likely still be a final sweep later in the year.
A retest of those lows.
A final sweep to establish the ultimate convincing bottom. It clears out the last of the leverage and tests the conviction of everyone who bought that first dip.
Okay, so let's synthesize all this for you. The 4-year cycle is very much intact, but it was an institutionally led apathy top.
Right. And that quiet peak explains why this consolidation is a slow, frustrating grind instead of a quick, violent crash.
And maybe most importantly, those common liquidity narratives that dominated the conversation were, well, factually backwards.
Bitcoin is a leading indicator of monetary stress, not a lagging one.
So this period you're experiencing right now, it isn't a breakdown of the asset's structure, it's a necessary test of conviction.
The final takeaway is that patience isn't optional here. It's not just a good idea. It's the foundational strategy you need to navigate this part of the cycle.
And if we connect this to the bigger picture, what really stands out is Bitcoin's sensitivity to things like unemployment ticks, Fed action, and its tendency to signal this liquidity stress 6 to 8 months ahead of time, which raises a really important provocative question for you to think about. If the current consolidation suggests Bitcoin already peaked well ahead of traditional liquidity measures, what kind of significant structural economic stress might this apathy be signaling for the global economy, specifically in mid-2026?
What is this early warning system trying to tell us about the future of traditional finance?
That is the complex puzzle that high-level market participants are already working to solve.
It is indeed.
We appreciate you joining us for this deep dive into the cycles and the liquidity narrative.
And if you want to continue the conversation and, stay updated with the broader Bitcoin ecosystem, check out the Discord link in the channel. Mo will keep you updated there with ongoing research and insights from the team.
See you next time.